Hey traders. Okay, in this video we're gonna talk about trend identification. How do you guys look at the chart and figure out what is the trend, how to mark your trend levels, and what you need to know. So whenever we are looking at a chart, so this is an example of Euro USD. So currently we are at this point. So what you need to know about trend identification is few things. You have one is market going up, next is market going down, and then you have market which is in the range. That means it's not going up, it's not going down, it's just going up sideways. So these are the three types of market that's going to happen. So first is, let's say market is going up like this. So you always need to look at the extreme points. That means, like, at this point, this is a significant point where from this point it started to go up, and then from this point it started to drop, and from this point it started to go up. So these are all the extreme points. So if I mark that in the chart, it looks something like this. So we mark here, we mark here, we mark here, we mark here, 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 here. So this is range, and then here. So now if we look at it, it looks like market is from here is going up, and then this one is going down, and then this one is going a bit slightly up, and then this one is really dropping. So overall, from the lows you see it's increasing and then slightly decreasing, and then the highs is dropping, 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 and dropping. So we can say that at this point it's still in the range market. That means market is going up sideways and then started to trend downwards. So as we go further, you can see it's also going down, down, and down. So here we can say this is a market is trending lower. That means the highs are getting lower and the lows are getting lower as well. So this is one way of doing it. So you can go inside deeper and then do each points, or you can do it in a bigger, like this, bigger. That means you avoid looking at all the noise happen inside of it if you want it to be easy. Okay, so from this point it's going up, because let me draw that line. See, it's going up, the highs are going up, and then from here the highs are going up, and then it went into a range sideways, and then it started to drop. Okay, so what are all these levels called? So here, so this is your high, this is your low, and this is your, what is this? It's higher high. So it's higher high, and then this is your higher low, and same thing, higher high and higher low. And then it, at this point, is it higher than the previous high? No, right? So it became a lower high, and this is lower than the previous low, it becomes a lower low. Same thing, this is lower high, and this is around the similar point, so we just call it low for now. You don't want to complicate things. And then this is lower low, lower high, sorry, and this is lower than the previous low, so lower low, this one is lower high, and then this is lower low, and then lower high. So this is basically how you want to identify the trend, so it's easier for you to see. Another way is you can use an indicator called moving average. It won't show you the exact lower low and lower high. You can put to 50. So what does this 50 means? It's 50 last 50 candles, the average price. So it shows you the movement of it. So now we can make this a bit thicker, so this way you can see all the you see the movement like that, like a wave pattern. And then so now it's easier for you to identify that. So let's go to another chart, let's say GBP USD. Okay, so at this point we can see here it's ranging, so their highs and lows are pretty similar, and then here it started to trend downwards. Okay, so how we want to take a trade? So usually what tends to happen is, let me draw some stuff at the top. So when the market is creating higher highs, okay, so all we need is low, a high, higher low, and a higher high. We need 4 points. So when we have the 4 points, what we can do is we can mark the previous high which it has broken up to create a new higher high, and then we can wait for the price to come back to the zone area of your previous high, and then you can take a position. Okay, so let's say market comes slightly below the previous high, and then it starts to range, and then it starts to go up back. So when you take a trade, let's say you take a trade long position, so this is more based on probability. That means out of maybe 10 trades, maybe 7 would win in this way. But what you need to know is, this only happens in a trending market, because when we are trending, the market creates a higher high every single time and higher lows. The lows are getting lower, the lows are getting higher, and the highs are getting higher. So what we'll do is, we take the trade around this area, put our stop loss right below the previous low, and your take profit at where the high it came from. So this way you can always guarantee a trade. Okay, don't try to target above or what. For the simple trading strategy, we can just use this for a start. So this is for buy, and for sell, same thing. We find a high, and then we find a low, and then we find a lower high, and then we want it to be a lower low. Then we can mark this low which it has broken, and then we wait for the market to come back. So let me just change this color to green, and then this one to green. So when it comes back here, you can take a trade of a short position. Your stop loss is above your previous high, lower high, and then your take profit it as at its lower low. So this way you're always guaranteed, and this is not a very high risk reward. This is usually, when you take trades like this, is usually 1-to-1 ratio. So you won't be getting like 1-to-10 or that kind of sniper entry position. You don't get that kind of levels. So this is more like market drop and it retraces. It's correcting back to that area where a lot of sellers might be around to push the price even lower. So we will follow one concept where you see now, let's say something is at $1. Okay, let's make it a bit more interesting. So this is $15, and then the price went up to, let's say, $30. And then imagine yourself looking at the price like this. From $15 it went up to $30. You never take the trade. You missed out on this trade. So at this point you are waiting for it to come a bit cheaper, then you might be going into it to bring it higher so that you can sell higher. So those people who have bought at $15 will be taking some of their profits at $30, obviously. So that's what happens when they take profit. Markets, drops down slightly to attract more buyers. Let's say when the market comes back to this point, so maybe around $20. It'll make people feel like, okay, I might be going into the market, it's cheaper than the high, so I'll buy more. So a lot of people who have missed the trade here, they would be taking the trade and pushing it even higher. So let's say here the market reached $50. Same thing. Those people who never take the trade here, miss the both trades here, will be looking at this, will be like, oh my god, I could have bought from $15, I could have bought at $20, I didn't buy, and now it's at $50. So let me wait for it to come back a bit lower, and then I'll buy, because I don't want to buy at so high price. So they will be waiting for it to drop even lower to buy more. So let's say market comes back to around, let's say, $29. So they'll feel, this is quite a bargain, I might think about it. So more people will be buying. So that's how I look at it from this point of view. So same thing at this point, we can look it at this way. So here we have $50, and somebody wanted to sell at $50 but didn't get the chance to sell at $50, and then the price gone to, let's say, $30. Okay, so this one did it, $30, and then they would have think like, oh my god, I could have sold at $50, made so much of money, now it's at $30. Now mind, let it go up a bit, I'll sell more, and then maybe it went up to $40, and then some people sold, take profits, and then market drop even further, and then it gone down to $20. The same concept. So it's all about the psychology of how traders are reacting at specific levels. So this is not some 1000% strategy or what. This is a simple strategy where everyone can start and try it on a demo account, try it on a, like I mentioned in my previous video, how to set up your paper trading account on TradingView itself. You can try this with risk free, without risking any of your money. You can try this 100, 200, 1000 times, whether it works or not. So you can go to a chart, you can go to the chart, and then first mark those levels, mark those low, mark those high. Okay, keep drawing. Mark those highs, then mark those lows, high and low, and then look at it from a point of view where, if I miss the trade here and I miss the trade here and I miss the trade here, so is it a good time to be buying now? No, it's not, because it's at the high point. Or you can draw it from here, this is one area, and then you can draw it from here, another area. So you're waiting for it to drop below this, then you can take a trade to buy, because now your risk reward is very bad. Let's say if you would have bought here, your previous low is here and your previous high is here. This is a very bad trade. So you want it to be at least 1 to 1. So look for something, market retrace bottom here or something like this. Then you can put your trade stop loss here, and then you can target the top. So this is close to 1. You risk $1, you make $1.93. Okay, or you don't want to go to daily chart, you want to go to lower time frame. Same concept applies here. Okay, let's remove this. Okay, you want to go even smaller in a very minute time. That means you don't want to look at bigger picture, you want to look at, I want to do some scalping. Same thing applies. Find your lows, find your high, first mark those levels to get an idea of what is currently going on in the market. Is it going up, or is it going down, or is it ranging? You need to find that out first. So look for significant highs and or significant lows. So how you do that is, each time your lows connect to another low, is it significant? Is it, yes, this is significant. That means this low is higher. This low is higher than the previous low. It's quite high. And find out, is this significant? This is not as significant as this, but it's okay. Same thing like this. But what happens here? Suddenly it dropped. Okay, and it dropped. And then this low above this low. So it's not that significant. So this is like it's turning into a range market now, because you see the lows here are just similar. So this is something you want to avoid. Okay, let me delete all those, and then let's say we go to a smaller time frame. Just try to see if we can get any entries or not. Okay, so it applies here as well. So let's analyze from this point of view. So we can say low, high, higher low, higher high, higher low, higher high. This is not that significant. This one didn't break, so let's just keep here, and then this one. So where we want our where it has to retrace here. Okay, so now we can see this was our previous low. It went up. This one also you can count it, but this is where it started the move to come up to this level, to this level. Okay, so this is your higher high, and then this is your higher low. So we missed the trade. So let's say we would have taken it, let's say here for example, and then we would target it to be here, and our stop loss to be below here. So this is, see, it's not a very good very high risk reward. It's okay. It just gets you in the trade and see what happens. Let's say if it drops further down, maybe now you would have break even. That means your stop loss will be in your entry level, because it have moved pretty much. How many pips is this? Okay, let's say you take a position here. This is around 50 pips, 57 pips. This is okay for you to break even. So let's say it drops back down, let's say it goes down a bit more, you can take at a lower price and get a better risk reward. But this is just for a beginner strategy where you can test it out and see how it works. Okay, so let's see another chart. Let's see NZD cat. Okay, so let's go 1 hour. So this one is currently in a range market. You see, highs are pretty much the same, and at this point, okay, this one is dropping a little bit. Let's see in daily chart. Yeah, you see, it's not much. This one is dropping, this one is dropping, but you see market is very choppy at this point. We want to try to avoid this kind of trades. Like I said, we want to look for a market that is going up, retracing, going up, retracing. We want this point to be significant. We don't want it to be like this, or like this. That is not sign of a very strong trend. That's sign of just market, something like this. I'll give you an example. Okay, like this. And in a shorter term, this is uptrend, smaller picture, but is it a very strong uptrend? The highs are getting higher, the lows are getting higher as well, but is it a very strong uptrend? No. We want to look for this kind of move where when it breaks the previous high, it is breaking it like with a lot of momentum. That means the difference from your this high to your previous high is a lot. That is when you know that okay, this is buyers in control or sellers in control. Not when things like this is like uncertain, like price came up and then dropped, penetrate, then rejected and then drop, retrace so deep down and then go up, and here it's so much of rejection. We don't want that. Okay, I'll give you an example. Let's say BTC. Okay, yeah, like this. Okay, so let's look for Bitcoin. So this was your low, this is your high, this is your lower high, a higher low, higher high, higher low. This is very nice. See how the break is. This is very impulsive, and this is very significant. This is what we want. We want it to be significant and then drop, retest at this level and then go up. Same thing currently. Okay, this was your high, created a new high. Is this significant? Not so. It is okay, you can say it is going up, but it's a weak compared to this and this. Okay, so what you guys can do is take a chart and do some practice. Just take, go to your paper trading, just take some entries, take a screenshot and see why you took the trade. So when you see this every single time, you go to maybe 1 minute and then you do your analysis there, like okay, try to find, okay, at this point this is your low, this is your high, and then this is your higher low, and higher high, higher low, and then higher high, and then you mark, okay, at this point it broke significantly, so if the market drops back again, I would buy. And then let's say if you buy and then your long position, let's say you buy here, and then your take profit is your this high, and your stop loss is just below here, 1 to 1. Okay, let it see what happens. If it's making you okay, it's going up, it's making you profit, and then take a screenshot and then find another setup and then do that again and again and again until you're so good at it. Then you can refine and fine tune it. That means you can say to yourself, okay, rather than waiting here, let me wait at the bottom, because I know 70% of the time it comes to this point, things like that. You will fine tune as you go. You wouldn't look at it from a point of view that, oh, this one only here, because every chart acts differently, has different kinds of nature of traders inside the market, so you never know. So you have to test it out and see for yourself what is the best approach for this pair or this certain pair or forex pair or stock market. Everything follows the same concept, where this market is always going up, sellers take buyers taking profit, market drops, attracts more buyers, and then price goes up, attracts those people who sell again and again. It's all just happening in a big circle basically. Okay, so the next video will be talking about how to use trend identification with Fibonacci. So Fibonacci is a tool that a lot of traders use that. So this is not financial advice. This is not telling you that you need to use this and make money. No, it's not like that. I'm just teaching you these are all the ways that you can use to analyze your chart and to have a better prediction, to look at the chart and say, okay, my probably in the probability sense this might happen or this might not happen, things like that. So how to add different kinds of confluence into your trading, so to justify what you have done. Okay, thank you so much for watching and see you in the next video.